Latest Consumer Financial Vulnerability Index, or CFVI, shows consumers are suffering severe strain on their cash flow. In the Power Lunch Johannesburg studio is Carel Van Aardt, who's a professor at Unisa. Professor, thanks so much for joining us this lunchtime. This is quite a dramatic sort of move. I mean, this is not an indicator that many people would be aware of, but clearly it's an important one because the index has declined sharply from 58.9 points in the first quarter to 48.6 points. What are the implications of this?
Well, I think there's a variety of implications, and I think some of the most important implications is that where we thought that South Africa economically was on a recovery trajectory, and that this recovery trajectory would just go on and on and on, it's very clear from this that this recovery trajectory is not continuing on the momentum that it had. And I think there's quite a lot of other statistics that's actually showing the same pattern. That include, for example, recently that we've seen from the Bureau of Economic Research, their business confidence and consumer confidence indices way down, and analysts also expecting much lower retail figures for that quarter, as well as what we've also heard is much lower expectations with respect to GDP growth rates for the second quarter.
Yeah, there's all sorts of numbers coming out at the moment that are not exactly showing us, covering ourselves in glory in South Africa. And there are certain people that talk about GDP actually being below 2% in the next 12 months or so. Let's get back to the CFVI, though, if we can, Professor. It says here, the decline means that consumers slipped from mildly exposed, as you put it, to risk, and their cash flow position in the first quarter 2012 is now it goes from mildly exposed to very exposed in the second quarter. Is this dangerous, and what are the broader sort of implications for the economy, maybe for retail stocks, maybe for the high street in general in South Africa?
I think this is clearly showing that households are continuously under strain, or consumers continuously under strain with respect to the cash flows, because remember, the Consumer Financial Vulnerability Index basically measures the cash flow situation of households in terms of their incomes, their expenditures, their debt servicing, and their savings. And this is clearly showing that the amount of money that's available to spend by households are being constrained. And also from this survey, it was also very clear that the main reason for that is that quite a lot of households are actually reporting that they're really struggling to pay everything that they have to pay, so the expenditures stream under pressure. That they're really struggling with respect to debt servicing. And this is actually very interesting because we've recently also seen the drop in the repo rate, and it's very clear that quite a lot of households, as you've mentioned earlier, has taken on quite a lot of credit recently, especially unsecured credit, where they're paying fairly high interest rates on that, putting them further under pressure. Also taking into account that when you look, for example, at the GDP in South Africa, that about 60% of GDP is because of household consumption expenditure. And this is especially so given the fact that we're not really doing very well on exports, especially with a lot of our export partners in Europe experiencing problems. So the implications of this is lower household consumption expenditure growth then would also then eventually mean lower GDP growth. And as you say, it can come in much lower than the original expectation of about 3% for 2012.
Professor, it's very interesting that you say when you see the CFVI and you see that the consumer is under pressure, does that then prompt the consumer who is under pressure to go out and seek unsecured loans in order to relieve their situation, and by doing so actually exacerbate the very situation that we're trying to avoid?
Correct. One of the additional analyses that we've actually done was to have a look at the time series, and we've got a time series now of data from quarter 2, 2009, and the benefit of that is that we try to ascertain, for example, how is everything linked together, the various sides, income, expenditure, debt servicing, as well as credit. And what became clear is that the first variable that's being impacted upon in bad times is expenditure. And there, quite a lot of consumers might, because of price increases, become under pressure. When they come under pressure, they've got various sources of income. The one is, for example, employment. If that is not successful, and you've seen the very high unemployment rate, they have to access credit to survive. And unsecured, and quite a lot of the consumers, as we've seen from the NCR's other statistics with respect to the actual state of consumers with respect to credit, about 48% of them are in arrears for quite some time. And these guys are not easily going to get mortgages, etc., so they have to move towards unsecured credit to survive. However, quite a lot of that credit taken is not spent to strengthen household balance sheets, but we actually seeing that they're using that money to a very large extent to finance consumption expenditure, and here especially of durable items, etc. When they are not successful in getting jobs and they have to repay quite a lot of this credit, we're seeing that they're becoming under increasing strain to service their debts, etc. And that could, over the longer term, create quite a lot of problems for South Africa.
It really does. It's quite a disturbing index, actually. I don't know how long it's been going. We haven't got time to explore that, but thanks so much for your time this lunchtime, Professor. That's Professor Carel Van Aardt, Professor at Unisa, talking about the consumer financial vulnerability.